In my many SaaS engagements, I often fill a role in educating teams on SaaS metrics. SaaS metrics are the non-GAAP measures used to evaluate a company's performance because GAAP financials do not always provide the most complete picture. There are three types of SaaS metrics. The first, which I refer to as top-line metrics, are forward-looking metrics that describe the very earliest revenue activity. These are bookings and billings. Bookings can be defined as annual contract value or total contract value. These terms describe the contract value over the 1 year and over the lifetime of the contract. Billings is the customer invoice date, which occurs after the bookings date. Because both the bookings date and the billings date precede that of GAAP revenue, they provide an advanced view of future revenue. The second type is recurring revenue, expressed as annual recurring revenue, ARR, and monthly recurring revenue, MRR. These metrics represent the revenue a company expects to receive from customers over the future respective period. SaaS company valuations are based upon ARR and calculated as multiples of the company's current ARR. The nature of recurring revenue can lead to high valuations due to lower certainty surrounding future revenue. However, companies must closely manage unit economics, which is the third type of metric. The term, unit economics, refers to the measurement of the revenues and costs associated with a customer cohort on a per unit basis. A cohort is a set of customers grouped by a specific unit of time, usually 1 month. To achieve revenue stability, companies must closely monitor changes in customer cohort from period to period. Key unit economic metrics include the magic number, defined as the change in revenue driven by the sales and marketing expense, which is calculated as the increase in revenue from one period to another, divided by the sales and marketing costs from the prior period. Customer lifetime value, or CLV, is the net present value of the customer cohort. Customer acquisition cost, or CAC, represents the cost to acquire an average customer. By dividing the former by the latter, we get the CLV to CAC ratio. Successful companies will demonstrate a ratio of 3x or higher. A similar metric, customer acquisition cost payback period, represents the number of periods needed to break even on the acquisition cost. For the organization as a whole, we use a metric called human capital efficiency, which measures revenue per employees. For private companies, we use the annual recurring revenue number per employee, while a trailing 12-month revenue per employee metric works better for public companies. The human capital efficiency ratio varies by average annual contract value, go-to-market strategy, product complexity, use of contractors, and geography. But I find that scale is typically the most important factor. At FLG, we have a well-known reputation as SaaS experts, with depth across sectors, startups to enterprise-level operating companies. We help companies track, interpret, and report SaaS metrics and use benchmarking to develop strategies for competing.